Hello and welcome to the Currency Exchange, NatWest Markets podcast, where we break down the major themes and events driving markets in this week and the weeks ahead. Today I'm joined by Brian Daingerfield, who is our head of G10FX strategy based out in the US. Brian, it's been a very busy August, and despite the fact that it's supposed to be seasonally a supportive month for the dollar, it has been anything but, with the dollar down against some of the major currencies. What have been the key drivers for this, and what are you kind of watching, or what should we be expecting going forward?
Thanks very much for having me, Eimear. Yeah, as you mentioned, it has been certainly a busy month of August for the dollar and for global markets. And I think the big focus here has been on the U.S. economy, how the moderating U.S. economy has fed into expectations for the Fed easing cycle. As we record this on September 5th, on Thursday, we are all still waiting for the non-farm payroll report on Friday. And it feels like, by the time you listen to this, you'll have seen that report. So you may have a better idea of where the Fed ends up going at its September meeting. But the Fed has seen enough to allow for the easing cycle to firmly begin. And now the bigger question is, what is the size of that easing, that initial move lower in the policy rate? Is it 25 basis points or 50 basis points? And what is the case for continued moves, either in a more aggressive posture or maybe in a more cautious posture? And over the last couple of weeks, we have seen a lot of second-tier data in the U.S. has maybe pointed towards economic conditions remaining stable, albeit at a more moderate pace than we had seen certainly in the beginning of the pandemic. Continued declines in inflation, which have been certainly welcome news for the Fed, but a second quarter GDP revision that we saw during the final week of August, where personal consumption in the second quarter was actually revised up pretty notably, and GDP in the second quarter actually rose up, was revised to above 3%, which is a pretty good vote of confidence for the consumer, at least into the end of the second quarter. But we have seen moderation in the labor market. We have seen a slowdown in inflation. And the way the Fed's language has evolved has, I think, rightly incorporated not just inflation, but also the growth and employment side of its mandate into its thinking, with Powell essentially saying at the Jackson Hole meeting in late August that now is the time to adjust policy. As mentioned, I think a lot of, for the dollar, it's all going to come down to the speed of that adjustment and the timing of how quickly do we get that adjustment and how forcefully do we get that adjustment lower in the policy rate. Now, as I mentioned, you'll have seen the NFP as you're listening to this, the big employment report that comes out on the 6th. And so that's probably going to be the biggest vote in favor or against moving a more aggressive 50 basis points or a larger 25. But as we see it today, that we think that the case for 50 basis points could absolutely be made as the Fed's first move and maybe even future moves. We think that we're seeing a slowing economy, a moderating economy, and a labor market that's simply not nearly as tight as it was even a few years ago. And so we have a labor market that's showing signs of loosening back towards pre-pandemic levels. If you look at JOLTS, for example, job openings have returned to levels that are closer to where we were at the onset of the pandemic. The unemployment rate has been ticking up from a more broad perspective. And so we think that the case for policy rates to remain as restrictive as they are, several hundred basis points above the Fed's own longer run estimate of neutral, we think the case for rates to be that restrictive has simply fallen away here. And so for the dollar, what that means is we think the dollar is losing several of its key supports from earlier in this cycle, both from the relative rates channel as the policy rate comes down and from the relative growth channel. And so I think for the immediate term for the dollar, the biggest input will be whether the Fed is given the sort of leash to move a little bit faster or if they continue to take maybe a more cautious approach and move towards 25. We think the case will be there for the Fed to maybe move a bit more aggressively. And so we think those supports are going to continue to fall away. And I think that portends some further weakness for the dollar as we head into the end of 2024.
And Brian, I have to ask, we are recording on September 5th. It is exactly 2 months away from the U.S. presidential election. I'm not sure if markets are focused on it right now. As you said, there's a lot of attention on the Fed. What will it mean for the dollar as we head into that event? Are there any kind of near-term political risk events in the U.S. that we should be watching to give us a good guide?
Yeah, absolutely. We are heading into the home stretch for the U.S. presidential election. And for the dollar, I think you rightly put it there, Eimear, that markets, I think, are seeing this still as a secondary driver. And I think that's understandable given the macro cycle appears to be shifting in the build up to this major event. But of course, fiscal policy is a very important input into market expectations for inflation, market expectations for the Fed, and of course, market expectations for growth. And so all of these assumptions that we have may have the potential to shift depending on the result of the presidential election. If you were to get a result such as united government under, say, a Trump administration, that could lead to significant new fiscal stimulus, maybe higher inflation expectations, that maybe lead the market to question whether or not the Fed can cut as aggressively as we think could otherwise be on the table. So that obviously has very important implications for the dollar. And of course, there are foreign policy implications and trade policy implications that we'll touch on when we move to Eastern Europe in a second here. But as we think about the more near term, the big event coming up is the September 10th presidential debate. So this will be the second presidential debate of the cycle, but the first presidential debate since Biden gave up the nomination and Harris took over the top of the ticket. So what we have seen in the last couple of months, since she took over the ticket in late July, Harris has seen a pretty clear wave of momentum, positive momentum, I should say. And it's actually pushed her into the lead over Trump, both on national polling averages, in betting markets, and in key swing states. You're talking about the Midwestern swing states, Pennsylvania, Michigan, and Wisconsin. She actually holds small leads in all of those. If she were to carry all of those states in November, I think she'd be pretty likely to win the presidential election. And same for Trump if he were to carry those three states. So Harris is riding this wave of momentum. And certainly some of that momentum probably relates to the fact that she's not President Biden. She's significantly younger, a lot more energy, and generally the disfavorability that we saw for Biden, especially in the aftermath of the June debate, doesn't appear to have filtered as clearly into towards Harris, right? That Harris is sort of seen, I think, by voters, certainly Democratic voters, as someone wholly different from Biden. But she is a member of the Biden administration, and she does bear some responsibility for the record of the Biden administration. And that record, especially on an economic side, is something that voters tell us that they're not exactly enthused by, right? High inflation. And now, more recently, we might be seeing a slowing labor market as well, just in time for the November election. A poorly timed development for the Democrats, I would say. And so this debate gives voters the opportunity to basically be reintroduced to Harris. Harris's campaign has this has been a whirlwind campaign, a truncated campaign. And Harris has seen that upward momentum, but that momentum has happened during the summer when a lot of people, frankly, are not paying attention. Now that everyone's back to school, back to work, we're post-Labor Day, I think the market and the voters are going to be paying a lot more attention. And this is going to be an opportunity for Harris to get in front of the nation and in front of Trump and pitch her view to Americans. And do Americans like what they see? Or do they see Harris and say, maybe this is closer to Biden and some of the disfavorability comes back in? And so that momentum wave for Harris, I think, faces a pretty key test. When it comes to markets, we talked about markets seem to be, this is sort of still a secondary issue for markets, at least for the moment, as we think about the broader drivers of the dollar seem to be more focused on the economic cycle. But last time we had the debate, that really shook up markets in terms of expectations for who would win the presidential election. And this event could absolutely bring the same. If Harris does quite poorly, all of a sudden markets could start to shift back towards Trump. And we know that has pretty important implications. In our view, a Trump victory would be the stronger dollar outcome. And so that's how we would see it. If the markets move their implied probabilities back towards Trump, we would see that as stronger dollar, and vice versa in the Harris camp. Although we probably should warn, it might be difficult to interpret the specific result into a specific outcome because there's so many other moving factors, not least of which is the Fed and the economic data that we're going to be getting next week. But as we look forward to November 5th, the debate next week really feels like it could be a moment for either Harris to solidify and extend that momentum, or maybe she doesn't do so well and that momentum starts to peter out a little bit. So, Eimear, I want to turn to you now. I know your focus is on some of the Eastern European currencies. And as long as we're talking about U.S. elections, there is, your region of focus. That's one where foreign policy and the differences between a Trump or a Harris administration could be very significant when it comes to foreign exchange. So I did want to ask you, how are you thinking about Eastern European currencies now? And how are you factoring in the potential risks of either a Trump or Harris administration on the economic outlooks in your region?
Yeah, I have to say, when you're talking to investors, they're not really sure how to play a second Trump election. And many people are kind of defaulting back to what it meant for emerging markets back in his 2016 presidential run. However, this time, he has stated very clearly kind of two quite concerning things. So really, he's consistently said that he wants a swift end to the war in Ukraine. And also he's openly questioned the US's commitment to NATO. So this has really big implications for the Ukraine war. And obviously, the countries within that region. I guess the risk is that any kind of swift end to the war in Ukraine probably implicitly means that it would see Ukraine, ceding territory to Russia would be seen as a defeat by Kiev and a victory by Russia. And I also think, that combined with really Trump's, really kind of threatening that actually then implicit support of the US through NATO may not be there any longer, really risk emboldening Russia. So you see a more aggressive Russia perhaps, and one that really wants to expand beyond the borders of just Ukraine, so moving further west into that Eastern European region.
Yeah, it certainly feels like the next U.S. president is going to be really important in terms of setting policy, not just for the U.S., but really for the world as regards to as regards to Russia, Ukraine. So, did want to ask you to focus in on currencies as well. What do you think this means for the region's currencies?
Yeah, so I think, the country that is the most at risk here, that faces the biggest security risk, is Poland. Poland is a former Soviet country, but also it's a NATO ally that is right on Ukraine's border. And we really think that, if Russia wants to expand further west, they'll want to kind of test the NATO alliance to really show, is it a real alliance? Will they be there if one member is tested? We've already seen kind of a number of destabilizing events on the border between Poland and Belarus. There's also been accusations of Russian spies who have been active within Poland, who've already been arrested and are under kind of investigation. We think we could see basically an escalation of these events within Poland. And we do not think the Polish currency is yet to significantly price in that risk. I think everyone kind of in currency markets is so focused on monetary policy divergence, right? Which central bank is cutting first and cutting fastest. And because Poland actually had a central bank who basically stopped easing back in October, their currency has actually been one of the most resilient. It's actually been the top performing EM currency year to date. I would say actually part of the central bank's reluctance to ease policy is because they're already on a defensive monetary policy footing. We know in the precedent set by Ukraine that if you're, entering into a security risk, or security concern, you want a high interest rate so that you retain foreign capital and you're able to protect the value of your currency. So I think that does play a part in the fact of why Poland is being kind of in contrast to all the other regional central banks. We definitely think, you'll see a higher risk premium priced into Poland. And I would say perhaps the other side, and the positive side to a Trump presidency, is that kind of Hungary may be a beneficiary. Hungary's Prime Minister Viktor Orban has very close ties with Trump. We know that Trump likes to negotiate on a one-on-one relationship. So perhaps it reduces the risk for Hungary of further kind of reprimands from the EU and freezing of EU funding, because they'll see Hungary and its Prime Minister Viktor Orban as really key in negotiating a better relationship under a Trump US presidency. That is probably all we have time for this week. Thank you so much for listening. Brian, thank you for joining and for talking us through all things dollar and US election. If you did like the podcast, please do remember to click like and remember to subscribe so you get the latest episode first. Thanks again.